RavenPack is a provider of big data analytics for financial services. We provide very detailed analysis of news, filings, transcripts, anything that is being said about companies worldwide. And we've been doing that for the last 20 years, which means we have a massive historical archive as well as the ability to do this in real time. And when you think about ESG, one of the main areas where our clients are really keen on is using a sentiment metric, and whether an ESG sentiment score will impact the stock price. And what our research has found, and again, we do a lot of data science work on our own data, we found that negative ESG sentiment leads to short-term underperformance. So it's an interesting signal where you can see that as soon as the ESG sentiment starts to drop, you should expect immediate underperformance of that stock. But what's interesting is that you then see a reversal of sorts, where on the long-term effects, you actually see the market tends to overshoot, and that leads to a reversal, right? The other interesting component is when you look at ESG sentiment indicators for the short term, you're able to see that they consistently outperform and they generate alpha across all market sizes. And we've done this analysis both in sample and out of sample, and found that in using or adding ESG sentiment to your portfolio, you're actually able to improve returns by significant value, and you're able to identify companies that are going to outperform in the short term. What's also interesting that on the long-term side, where many investors say, look, sentiment tends to be a short-term signal, it's short-lived, it decays rather quickly. When it comes to ESG, we actually find that it's a very powerful signal 3 months out as well. So there is essentially a consistent alpha component on the long-term side, where you have very little turnover, and you're also able to increase your portfolio size, where there's more outperformance, if you may, in the short term with smaller portfolios. But on the long term, you actually can triple or quadruple the portfolio size. And while you don't get as much return, you don't have as much turnover. So there's a trade-off there, but essentially ESG sentiment is a key component to alpha. The other thing we do find is when you combine our sentiment data with more traditional ESG ratings, in this case, MSCI. And what we did find through our research is that good ESG, right, tends to consistently outperform bad ESG companies. That's no secret. But when you start adding sentiment to traditional ratings, you actually find that good ESG with positive sentiment outperforms good ESG with negative sentiment. So essentially, that sentiment component has an orthogonal effect in your model. It actually contributes information that is not being captured by ratings. And one of the reasons for that may be that ratings are slow in terms of getting updated. There's also some issues around incorporating all the effects, and it's a very manual process. The other interesting signal is that bad ESG with positive sentiment outperforms bad ESG with negative sentiment, right? So again, another interesting and intuitive result there. It's not just about alpha. So there's the ability to minimize downside risk using sentiment. When you apply a good ESG rating or good ESG data, you actually manage to improve the downside protection against the market. And we apply a positive sentiment screen, right, on top of the good ESG scores. That tends to further improve the downside protection. So overall, you see this tendency where as you incorporate the market alone performs at a certain level, you add ESG ratings, that tends to help. But as soon as you add RavenPack sentiment on top of an ESG rating, you can actually see a significant improvement on the downside protection side. And when you add additional sentiment overlays, specifically integrating reversals, you can see that that tends to further improve performance and downside protection. So a lot of additional value coming from sentiment. And some of the key takeaways here are, socially responsible investing is being revolutionized by the use of AI, big data, and NLP. There's no question that these technologies are going to play a key role in ESG investing. Trading ESG sentiment as an event-driven reversal signal can also generate strong alpha, even as long as 3 months out. So again, it's a very important signal, not just for the short-term investor, but it now starts to play a role in larger portfolio management, where essentially turnover might be an issue and ESG sentiment is truly a factor that helps there. And then finally, filtering for ESG portfolios with new sentiment not only provides value in terms of alpha generation, but it also brings strong improvements in downside protection. So anyways, just a few key takeaways of using RavenPack Analytics in the context of ESG investing. And if you guys have any questions, or if you need access to the RavenPack data that is all about democratizing big data, please feel free to reach out.